Okay, it's March 10th and we've got a trade here. We've just bought a Home Depot call for 50 cents. We just bought the 150 put that expires in 10 days. It's way out of the money. Home Depot is trading up $7 or up 3.4%. Traded as high as 218. Dow's up 300 points. And Home Depot is right up there with the best of them, having a nice rally today. So getting into this rally, we're looking at volatility in here around 120+%, which is elevated, which could hurt our option position. But what we've done is we've bought one of the 150 puts for 50 cents. It says we're up $16 on the day. It hasn't traded other than the trade we did. And then what next thing we're going to do is, in case the market continues to rally up or vols collapse in there, we're just going to go ahead and put an order in at the 160 strike. Now this is called a limit order. I'm going to go in here, I'm going to put $1.50 as my price, and then I'm going to just leave it in there. And the bid is higher than my bid. Oops, sorry, not 150. Ooh, almost made a mistake there. I don't want to pay 150, I want to pay 50 cents. The bid right now in there is 62. So I'm just going to leave this in there, and then if the market rallies and someone wants to sell it to me when the stock goes up, then I could get filled. I don't have to watch it. So let's leave that in there, and you won't see it there because there's a higher bid than me. And we'll just leave it there and see what happens. Now, we're long one put and we're bidding for another put at a different strike. And if the market rallies while we're not looking at it, they may come down and take us. Now, we can look at this and get a sense of what this means in terms of our expectation on what is going to happen with the stock. So over here we have what's called a theoretical price. And what I've done is I've looked at this and I said, okay, if the stock drops by $10 tomorrow, it's up 7 now, what will happen to the price of this put? And the theoretical value shows that the one that we bought for 50 cents, if we drop $10, then it should go from 50 to 67, 68 cents. So to be honest, it's not a big move, is it? And the 160 put would be worth probably $1.58. So if we get a bit of a rally in here and then subsequently drop, we might be able to make 3 times our money on the put we're trying to buy now, and we'll make a little bit of money on the one that we already bought just now. Now, if volatility goes up, let's say volatility goes up by another 10%. If it does, then the put that we own right now will double in value, and then the other one would go up by 4 times, assuming we get it filled, and that means we need some kind of pop-up in the stock. So what I'm doing here with this little calculator is trying to get a sense of what's going to happen to my option if the price of the stock moves and what happens with volatility. These are the two critical components that will determine what the value of my option is going to be. And then we can move forward in time to get a sense of how time changes our option. So if you can see here, if I move one day, I'm at $1 today, well, for tomorrow, and if I move a day, it's going to lose $28 or $28, yeah, $28. So each day I'm going to lose $30 basically on this option. So if I paid $50 for it and I lose $28 each day, then it's going to be worthless in 2 days unless we get a move. So be very careful with options from the perspective of how much money you put in. Whatever you put in, you got to be willing to risk all of that, because you're either going to get paid out multiple times or you're going to lose the full amount. And this is a very similar strategy, if you were to approach it from a long-term perspective, that Warren Buffett uses when he trades, which is he never wants to be in a situation where he is forced to liquidate. So even when he shorted the S&Ps back in 2008, the agreement he had with Goldman Sachs was that when he shorted naked puts on the S&P, that Goldman Sachs would not be able to come back to him and force him to liquidate them at a loss. Basically, I had a contract with him which stated that if the S&Ps went to zero, he would be able to fund all those losses with his balance sheet from Berkshire Hathaway. So the strategy used by the richest man in the world is whatever investment you go into, you make sure that no one can force you out of it. No margin call can be made on you. if you take on that position. So that's what we're doing when we're buying options. We're risking what we're putting into it. No one can force us out. And then we just wait for the unexpected event that's going to make us an unexpected amount of profit. And that profit needs to be multiples of our risk. So we're not in here to make 50%. We need to make 400%, 500%, 1,000%. So that's the trade for today. We're long a put in Home Depot, and we're hoping that it drops, but the markets are random. We don't know for sure, but that's the bet we've placed.